freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, I like your green shirt. I'm glad you got the memo. It's very nice.
Just decided I should wear green. You know, I was using that camera I have that spies on you and saw that you were wearing green, so.
Well, that's not creepy at all.
I know.
Did you mean to say that? Did you just slip and reveal the existence of that?
Yeah, that was my bad. Sorry.
Yeah, that's very unfortunate.
Someone's got to make sure you're safe all the way back there in East Tennessee.
Yeah, I require a lot of supervision. I can't be trusted to
Can't be left alone.
Yeah, exactly. Like a child left alone at home.
Well, if you ever wander off, I'll know that you're at a coffee shop.
I was actually thinking about our trip recently in Tulsa and how you were just like, yeah, I know Dustin's going to get coffee, and oh yeah, he's going to this coffee. Like that was honestly the first thing once we established the hotel. I was like, okay, I got to map out the coffee spots nearby, and there's nothing wrong with it, man. There are worse vices to have.
We were driving back from the well, and then people are like, oh, I'm going to go to bed. I'm like, well, Dustin's going to be heading to the coffee shop. And he was like, I was actually just thinking about going to the coffee shop.
That was my plan. I already had it mapped out.
It was good coffee.
It was really good. It was one of the best pour-overs I've had in a while. So it's always a good thing.
But on that note, we did just get back from Tulsa, where we did a field trip with investors to our oil wells that we raised money for out there in December. If people are interested in learning more about oil and gas or want to see what some of these offerings look like, we don't have anything available right now, but these are normally 506B offerings, so you need to be part of our investor club, and feel free to reach out to us. Or I think the Wealth Independence Podcast probably has links to both of our sites and things of that nature. I know people can go to bidwellcapitalfund.com, and there's a link to schedule a qualification call, which is basically an introduction and some SEC questions. So pretty simple, but always good to meet people, and then you can get access to all of our offerings.
Yep, absolutely. Well, that's an excellent intro to today's.
It's not a great segue, but we will segue.
Sure. We have a guest today.
We do. Will Harvey the third, right?
Yes.
Okay. Maybe we'll ask him about that. I doubt we'll get to it, but that is what my notes here say. And he does private money lending, so kind of hard money. We've met a handful of people that do this. I mean, we have a debt fund ourselves, so a little different. It's a credit fund, so it's mainly pref equity and mezz debt for larger commercial buildings that we work with Aspen on. But it does some hard money lending. He's got some experience doing flips and things of that nature. So kind of all been around the real estate industry, but with a focus on finance and the debt side. So interesting to hear his opinion and kind of see what he's been putting together.
Let's dive into it.
Hey, Will, happy to have you on the show.
Yeah, thanks for having me, guys. Honored to be here.
We want to know a little bit about you. We obviously have some questions we want to go into, but why don't you spend a minute and kind of just tell the listeners who you are, some of your background, and where you're at today.
Yeah. So a little over 10 years ago, I got into the mortgage business. This was after I dropped out of the college I was at, and I was playing football and had double hip surgery, and that was the end of that. So came home and was sort of flirting around with finishing up my degree at George Mason in the Northern Virginia area. But a lot of my credits didn't transfer, and I just realized that I just wanted to get out there and start building. So a family friend got me into the mortgage business, and I was on a track. I started as a loan officer assistant and then learned the business for about a year or so. And then I jumped out into production as a loan officer at the end of 2016. So 17, 18, and 19, I was a loan officer and had a great run. It was a lot of fun. Made good money, and I was single at the time, no wife, no kids, so I was able to stash away almost all of it, and I started just deploying it into real estate, buying townhouses in the Northern Virginia area. I got to 3 of them, and I realized that one, that I go broke every time I buy one because I'm using my own money. And then 2, being a landlord sucks. So, I pivoted after that into multifamily, and me and a partner started a house flipping company, and I would take what I earned from that and I would roll it into syndication as a limited partner. So doing that was a beautiful thing because, I was considered a full-time real estate investor for tax purposes. So I could get those nice negative K1s from all the bonus depreciation, and it would offset the income from flipping houses, which is taxed as ordinary income. So it was a great thing, and, did that for a while. And then I sort of moved up into a couple syndications that I ran on my own with a partner, and they're small. They're not huge, 100 unit apartment buildings. One's a wedding venue and then one's a boutique hotel. But all the while, I just slowly migrated towards the finance side and just realized that I don't like being an operator. I don't like managing properties. I don't like any of that. I like being on the finance side. It's really where I just enjoy. It's what I'm better at. So that's what I do now. In 2023, I started a fund, and the goal with that fund was to invest in syndications and things like that as a limited partner. And when we first started it, we had some idle cash, and someone called me, and it was an old coworker, and he said, "Hey, I got this guy that." He was a loan officer. So he said, "Hey, I have this borrower and he can't qualify for a typical loan, but he makes great money. He was from another country." He said, "But he makes great money and he's putting down 75%. And I know you started that fund. Do you want to, do a hard money loan and first lien position to this guy?" And before he finished asking me that, I was like, "Yes, I'm in." That was a no-brainer. I mean, 25 LTV, first lien position. It was virtually zero risk. And
Just praying that he defaults.
that's like, I joked about that and said that it was like, if he makes the payments, great. If he doesn't, we're even better off. So yeah, so we did that loan, and then I did a few more loans from there. I think we did 10 in that fund, and it was totally accidental. I was just waiting for the phone to ring, wasn't marketing. And then, after that, I looked back after a while and was like, "Man, this is a real business and the returns are great. We should do this as its own dedicated fund." And so that's what I'm doing now. So I run a hard money fund, and we focus on the Richmond area. And yeah, I'll shut up because that was a long-minute introduction.
No, that was great. It kind of gave almost the whole timeline getting to where you're at now. Some of the things that I heard in there that I want to dive into, and maybe this is a good place to start it, is that you were an LP investor at first, right? You didn't just say, "Hey, those acquisition fees look great and I have no money in my pocket. Let me go raise some money and see what we can do." You actually were putting your own money in other people's deals as a limited partner. What did you learn doing that? What were some of the takeaways?
That's exactly right. And I've always played the long game. I've never, you know, I actually don't really, I have, it's somewhere on my website, but I wrote an article a while ago about how acquisition fees and disposition fees and stuff like that can diverge the interest between general partner and limited partners.
Mhm.
So I'm all about aligning interests and simplicity, and I think that that's the best way to do so. I wanted to start off and really learn it, and I actually did get involved with a couple syndications as a very, very small general partner where we raised capital and handled some of the due diligence tasks. And but I realized that was, again, I just slowly,
You like the
migrated to the
finance side.
finance side. Yeah, and I just, as I was flipping houses, I would make money from that and just deploy it into, it seems like there was always a deal ready where I could deploy it into. I had 2 or 3 sponsors that I worked with, and I trust them implicitly. One just exited the other day. It was a great return. Put money into it in the end of 2020, and it just sold. So that was about a 5-year timeline, and those deals are awesome when you're working with the right sponsorship group and they do what they say and they're experienced and all that.
So your primary focus now is the debt fund. Other than you just kind of preferring the finance side of the business, was there a return aspect? Or, if I'm putting on my investor hat, what is the benefit for me as an investor to kind of go focus on a debt fund versus a real estate deal or an oil and gas or stock market?
Yeah, great question. I think they're apples and oranges. I think that if you're looking at an equity deal, a real estate deal, like a 100-unit apartment building or mobile home park or something like that, or self-storage, whatever, and you're investing as equity where the sponsor is getting a loan on the property, and then 20-30% of it they're raising as equity. If you're investing in an equity position, that's a completely different type of investor or type of investment than something like what we're doing with a hard money fund, where what we're giving people is an opportunity to invest in a local market that I'm in, and it's all backed by first lien deeds of trust. So, it's just a little bit different than an equity position. I've been in equity deals before where the annualized return was 40-50%. That's not going to happen in our fund.
Mhm.
It's really not going to happen in any debt fund unless you're buying distressed debt and getting it to reperform. But that's a completely different animal.
Yeah, then it has a different risk profile with it as
Yeah,
well.
exactly. Right. So hopefully that answers your question there.
Yeah, it does.
To take a step back, I thought it was interesting. Will, you mentioned like the active to passive investing, right? And like you were doing something that was active and you took the funds from that and deployed it into something that was passive. And I just want to flag that or like put a pin in that may be something I'll come back to later. But like that's a thing that Adam and I talk about often. And we know a lot of people that do that in a lot of different ways. And that typically tends to be the way to build a whole lot of wealth, right? You get good at doing something that takes your effort and you take the fruits of that and deploy it into things that then start sending you passive cash flow.
Bingo, exactly. And that was with my partner that I was flipping houses with at the time. I would always talk to him about it. And I would say that in the order of importance for me, it's like, yeah, returns are obviously important in being in a deal that is going to generate a return, but almost equally important at that time, because I was, making good money flipping houses, was getting the ability to defer the taxes and to write off a lot of that active income. I mean, that was just huge and saved me so much money and allowed me to invest more money and build wealth a lot faster. They say that the two biggest destroyers of wealth are taxes and fees. So that tackled one of them. So it was definitely something that I would recommend looking into for someone that has active income that doesn't get any preferential tax treatment.
Sure. I appreciate you going back to that. I guess on the topic of the hard money lending, and Adam, I hope I don't step on something you were going to ask here. Okay. The debt space is something that I've always been fascinated in. I feel like I kind of connect with this, your statement about being drawn to the finance side, because I kind of find myself drawn to that too. And the hard money lending space has always been something that's personally interested me. But one of the things, and you think about it and it's like, well, it's nice to sit on that side. You're not really being the operator. But at the same time, truly running a hard money lending fund takes a decent amount of like expertise, right? And in terms of the underwriting and things like that. I'm just curious if you could speak on that and sort of what maybe an investor doesn't realize that goes into that and goes into what you actually have to know and the skills that you have to be successful at running this. Because it's not just a matter of throwing money at anybody that comes along and says they want to rehab a house.
That's exactly right. And it's all in addition to the knowledge and just knowing how to underwrite loans and do good deals and work with good borrowers. there's also a lot of work. That's what people think, that it's very passive. And, if you're dotting your I's and crossing your T's, then, you're collecting a lot of documents, you're moving a lot of documents, you're following up on stuff, you're looking at insurance renewals, you're doing all that. And it's not like you just make a loan and forget it and the payments come in and that's that. I would say it's more passive than flipping a house or managing a rental, but there's still a lot of work. So yeah, and to the underwriting side of things, it's asset-based lending. And I know a lot of hard money lenders who are strictly focused on the property and the deal, and they put very little emphasis on the borrower. But I have thus far taken a different approach. We put a ton of emphasis on the property, and we're not going to go over a certain LTV based on the after repaired value. So we're disciplined in that regard. We're always going to be conservative on what we think the ARV or after repair value. We're always going to be conservative there. I learned that from when I was flipping houses, that the number one way to screw up is getting that wrong. So we're always going to be conservative there. But I put a huge emphasis on the character of the person doing the deal, because that is, it's like, we don't do appraisals because appraisals are kind of meaningless, in my opinion, with what we're doing, because an appraiser can go out and say that, yeah, this property that's being purchased for $150,000, when it's all fixed up, it's going to be worth $250 or $300. And that may be true for one borrower, but it may be a different value for another borrower who has a different plan, maybe a better plan, maybe a worse plan. So I really think that putting a lot of emphasis on the borrower, getting to know them, getting to, share a meal with them and really pick up on their experience and just how they act, what makes them tick, what they say. There's a lot you can pick up on, and there's body language, there's stuff like that. And there have been some tells for me where I talk to someone on the phone or even better in person, and they make a comment and I'm like, yeah, probably not going to work with that person because of what they said there. And none of that shows up on a loan application. None of that shows up anywhere when you're running comps or doing any of that. It shows up from that, that scuttlebutt, the Warren Buffett approach, where you're looking very qualitatively as opposed to just quantitatively.
Yeah. So what I'm hearing is that you would probably never lend to Adam. He would fail the character test. I got it.
Definitely, okay. He would fail on the first conversation.
Yeah.
Yeah.
All the
fail
red flags
fast
just
is what my
up.
college professors always told me.
Yeah, that's right.
I guess so we talk about, Will, you talked about it's a lot of work on the operator side, right? And it's a different type of work than flipping houses or being a landlord or whatever, but it still is a lot of work. But through your fund, you've got investors that can invest completely passively, correct?
Correct. Yeah.
So
that's right.
Who's the ideal type of investor for this? Or like, who do you typically serve? What are they looking for? Because, like you said, debt's a totally different risk profile than equity investing or you're never going to see those crazy upsides, right?
Yeah, that's exactly right. I would say that our typical investor thus far has been someone that's older, and we have a lot of retired guys. I think, as you get older, you shift more towards bonds and less stocks, and this is sort of in the bond department, being that it's debt. These are guys that they're wanting predictability more than the opportunity to go out and make some huge return on a deal that, where you're swinging for the fences, like in some big value add multifamily project or ground up development or something like that. That's not the avatar, if you will, of the people that are investing in this. They want to, we pay monthly distributions. So they like getting their check every month, and that's what's important to them.
You do distributions monthly. And I'm assuming people can invest at any time, right? It's an open-ended fund, right?
Yeah.
Do you ever give them the option to reinvest their earnings compared to take the distribution?
Yes. At first I didn't, but now I do.
Do a lot of people end up taking that?
Most just want the earnings.
Oh, really?
Yeah. Most want the earnings. but I do have at least one guy who he just wants it to compound.
We're like the polar opposite. We do have a debt private credit fund. It's got about 45 million in it, and I'd say 85% are reinvesting.
Oh yeah.
Yeah, and we and Dustin were shocked, right? Because for the same thing, right? Monthly income, you pay your mortgage, whatever it is, no one wants it.
You guys in my fund, they want their cash, I guess.
Good. That's what it's built for, right? It's an income producing fund. You don't have to answer this if you don't want, but what are your rates kind of look like, right? I mean, we're in early part of 2026 right now, and rates have been a topic of discussion for the last, well, probably forever, but the last 4 years have been particularly sensitive. How are you seeing things?
So the first thing I'll say is we're pretty insulated and disconnected from what is going on with, rates in the traditional MBS market. That rates move, President Trump will give a speech and the market will react in real time and rates will go up or down depending on what he says. That doesn't happen for us. We're pretty steady with what we've been doing, and our typical product is a 9-month term. And we have extensions built in for a fee, but it's a 9-month term, and we charge a 3% origination fee, a flat $700 doc prep fee, and then the interest rate is 12%, and it's interest only, paid monthly.
Seems to be fairly in line with most hard money lenders. So I was just curious more than anything else.
I'm willing to get creative. I mean, at the end of the day, I'm focused on a certain rate of return, and how we get there is irrelevant to me. If it comes through the interest rate, if it comes through points and fees, it's really all the same to me. I'll give you an example. We have one guy who I've loaned to him, I don't know, 10 or so times. He's a great borrower. And he came to me one day, he calls me and he's like, "Hey, I'm tired of paying your points. How about this? We'll raise the interest rate and we'll reduce the points." And I'm like, "Let me get back to you on that." And I do the math. And I'm like, "Yeah, that'll work." So we now have an arrangement where we charge him a higher interest rate and no points. And the reason that he wanted that is because he's buying these properties, putting about $8,000 into them. So, a little bit of lipstick here and there. And then he's turning around and renting them and refinancing into a DSCR loan. And that takes him 1 to 3 months, as opposed to a full blown flip that takes, 6+ months. So he's like, "Hey, I don't want to pay all those front heavy points. I'd rather just have a higher interest rate. And I know I'm going to hold it for a shorter time. And so it works for us, it works for him." And that's the cool thing about having your own money and being flexible.
I'm kind of curious on the fund, the size and like how many loans you originate per year and what the turnover looks like, and maybe that's more the inside baseball kind of thing. But I'm personally curious about some of those mechanics. And then I guess the related question is how does any of that impact the returns to investors, or sort of the investor side of things?
How does size, like if we grow, does it diminish our returns?
Yeah,
it hasn't thus far. We're not a big fund. I'm in the process of right now the current fund that we have, which is open through the rest of the year, which was sort of a friends and family type of fund. It's a 506B, and I'm in talks with a few attorneys about doing a C. So if and when that happens, which should be soon, then it'll allow me a lot more flexibility to go out and show that, hey, I have proof of concept with this smaller fund. And I've been really hamstrung by the amount of capital that we've had available. I hear from other guys that are constrained by deal flow, and it's really been the opposite for us, which I think is a good problem. If you're going to have one of the two problems, I'd rather be constrained by capital, because that seems a lot more solvable than deal flow.
Yeah, you need a different business plan if the deal flow is the problem.
Exactly. The deal flow was almost immediate. And, I think that part of that was I grew a business as a loan officer, and there were a lot of parallels with that. Obviously, it's a different type of loan that we're doing with hard money as opposed to like residential financing. But but a lot of it is similar, and it just exploded, and I had to throttle all the all the marketing and all the stuff that we were doing to get borrowers, because we just didn't have the funds and didn't want to say no to anyone. So, or didn't want to turn them away and just tell them that we're out of money, because then they're not going to call me anymore.
Yeah.
So we're on the lower end. I think we have out like around 3 million in loans right now. But if, like I said, if and when we do the 506C, I'm confident that we can really scale that.
So, Will, looking on your website, I know you guys talked about investing in publicly traded real estate as well. I'm assuming it's like REITs.
Yes.
I'd love to hear a little bit more about that, kind of the thesis and what you're seeing.
Yeah, sure. So that's another fund that I have that's closed, but it's another friends and family type of fund that I started. It's actually the fund that I told you about that I did the hard money kind of accidentally, as guys called me. So that was that fund, and yeah, our core focus now, and again, it's kind of a accidental thing that I stumbled into, is finding these opportunities in the public markets that are mispriced, at least based on my opinion. And we've found a few, and how I stumbled on that is my father and another family member, the three of us pooled some money, and I'm the general partner, and this is a few years ago, and I went out and just looked in public markets for opportunities, and I found this. It wasn't even real estate focused. It was just sort of just wherever I could find value. And naturally, I kind of gravitated towards real estate. And there was this one company that I found, and I'm looking at it and I'm like, this is really cool, but I can't do anything. This fund is not really meant to do real estate, because I'd want to put a larger sum of money into it if I'm going to invest in a real estate deal. And that fund was only like 300,000 or 400,000. So I didn't want to use that capital for that. And then it hit me. It was like, this is a real estate deal. I can, per my limited partnership agreement, I'm allowed to use this real estate fund that I have. And the quick synopsis on that is that this was a liquidating trust that traded over the counter, if you know what that means. It was a very illiquid security, and it was formed in connection with JCPenney's bankruptcy. So JCPenney filed bankruptcy back in late 2020, and they spun out all their owned real estate into a liquidating trust. They basically separated the operating business from all the real estate, and they took the real estate, threw it into this liquidating trust, and then gave the shares to the various creditors who were owed money from the bankruptcy. And the creditors just dumped them because they don't want to own this. They want the cash, and they're just going to take what they can get. And this was just a very overlooked, mispriced thing where it was 130 properties, 130 retail properties with a 20-year master lease, absolute triple net master lease to the new recapitalized JCPenney that was purchased out of bankruptcy. And so all the leases transferred. It was our going in yield. It was debt free, and our going in yield was around 12 or 13%. And what they were doing was they were taking properties and they were liquidating them one by one. So it was basically an arbitrage play where we were able to buy it through the public markets at an implied cap rate, and you valued it all based on the NOI and all that. The implied cap rate was around 14%, what we were buying it for, which is crazy high. And meanwhile, they were turning around and selling these on the private market for 7 caps. So we were basically doubling our money just by being patient. And the gap closed pretty quickly after we built a position. We put a good chunk of our fund into it, and then the price went up, and I didn't buy it anymore after that. But that was an awesome, kind of our first big win with that fund was that. And it opened my eyes to what's out there, and there are a ton of opportunities in the public markets.
That's super fascinating, and That's got my curiosity going like crazy because I love this kind of stuff. But I think that also proves like the efficiency of the most common sorts of things in the public markets, right? That's why there's these sorts of opportunities don't exist there. But you start looking in these like these corners of the market that nobody else is looking in, you can find pockets of inefficiency.
Yeah, anyone who wants to say the markets are perfectly efficient, they are not.
Yep.
There are, when you're under $1 billion market cap,
Yep.
or if you're dealing with, we did very well on a spinoff. So spinoffs are very can get mispriced. So no, there are definitely pockets where you can find these mispriced opportunities, and like you said, in these odd corners of the market.
Super fascinating.
Yeah.
Well, we want to be mindful of your time. I guess the question we like to ask all of our guests here is, we're the Wealth Independence Podcast, and so I always like to know what those words, what wealth, independence, freedom, sort of what that means to you, how you live that in your daily life.
Great question. So for me, I'm a Christian. I'm a follower of Jesus Christ, and I have gotten to the point where I don't need anything beyond. I don't want to make money to enhance my lifestyle any more than it already is. I live fine. Me and my wife and 2 boys, we have a great life, and I'm really focused now on generating resources and using them to advance, to fund initiatives that advance the gospel and get it to places where it's not being preached, and that's really something that is on my heart and that I'm focused on.
That's really, really good.
Thank you.
If people want to get a hold of you, Will, what's the best way for them to reach out?
Yeah, they can go to my website. It's harvey-capital.com, or they can just email me, will@harvey-capital.com.
Okay. And we'll make sure that's in the show notes below.
Awesome.
Absolutely. Thanks, Will. Appreciate it.
Appreciate you guys. Thanks for having me on.
That was great. Will's got a wide variety of experience, and I'm personally, I don't know, Adam, you and I've talked about this. Like, I've always been drawn to like the hard money lending fund, but as one of the reasons I asked the question was because I like, the more that I explored that, the more I learned how operationally intensive that it is. Like, it's definitely not as, running the fund is not as passive as you think it might be.
Servicing the debt is a full-time business. I'm surprised he can get those rates. I mean, and I'm not harshing what he's getting in any way. I think he's providing a great service, and he obviously has some people he works really closely with and is able to meet their needs. But I've just seen over the last year, I've just seen those rates come way down. I mean, even the flips I'm doing, we're getting 8% and a 1% origination. I mean, that changes the deal. And so I'm glad that in his market, he's still able to get that.
I was going to say, I mean, I know that's like market dependent, right? And it was kind of funny to hear that, because in Atlanta, when I was doing this 6-7 years ago, that was kind of the going rate, right? It was 12-3 was sort of the expectation, and kind of that. I think he said he did 9-month terms, and we were usually closer to 6 for the most of the hard money lenders around there. But anyway, yeah, it's interesting, right? And it just kind of proves how local a lot of this can be. And if you supply and demand, if there's not a whole lot of people lending money for this sort of thing in a given market, then you can command higher rates. So definitely another illustration of that. I don't know. Outside from the rates and the comparison to what you're paying in Northern California, what big takeaways you have?
I just this almost feels silly to say, but part of what he was talking about and just listening to him, it reminded me of things I was doing 3 or 4 years ago. You know, like he's like, oh, I've got a few $1 million under management, and he's kind of doing this and a little bit of that. And he might do a 506C, and I feel like I did a lot of those things. So it was kind of fun to hear that. I think he's building a good business. He seems like he really enjoys the underwriting side of it, and it was a fun discussion. I think he understands the debt side of the portfolio pretty well.
Yeah, for sure. And can apply having more, I don't want to say institutional, but more formalized underwriting experience, right? And like knowing how to apply that now, in addition to knowing kind of the construction side and the market and what makes sense. I think that's huge in running a residential, like hard money lending fund.
Yeah.
I think for me, I mentioned it during the recording, but like he talked about the active to passive, right? Like he didn't exactly use those words when he described it, but How many times has that come up with that we've talked about, people that we've talked to? Like that's the play, right? Find the thing that can pay you well, and then live below your means and deploy that excess into stuff that cash flows. And it's a winning combination. It's worked for decades and decades and decades now here in the U.S., and I think it'll continue unless we have an entire reset of the monetary system and everything turns upside down. I think it's a play that's and a playbook that's just going to continue working.
Well, I think the real assets will continue to work, but that's a valid point that the debt could become. That's the biggest risk on the debt, is that monetary instrument gets wiped away.
For sure. And then I thought he talked about sort of going around and doing a few different things, but he was very clear on where he wants to sit, right? He likes the finance side of the deals. I think that's important. And whether you got people like kind of like what I used to be when I decided I wanted to go active, but sort of the same thing. It was like, well, let's try this. Well, let's explore this. And you eventually sort of learn where you like to sit. But even as a passive investor, I think it's important to learn that, right? The types of deals that not only align with like your goals, which is very important, but align with like the stuff that you sort of like being around. I guess a really simple example of this is, for me personally, I hated the volatility of the stock market, right? So that just was not a match for my style of investing. I don't like seeing the number go up and down so much all the time. So whether you're active or whether it's on the investing side, finding the thing that you like that matches your goals that you can just sit there and repeat and do over and over and allow compounding to happen. I think that's so important, whether it's a market, an asset type, a return or a risk profile. Like there's so many ways that could show up, but finding the thing and then just, sticking with it, I think is very, very important. Any other closing thoughts, Mr. Penn?
No, sir.
All right. Well, as always, we appreciate everybody listening here. If you enjoyed this, go do all the fun stuff. Go and give us a thumbs up and like and subscribe on YouTube and 5-star rating on Apple Podcasts and whatever it is that you do on Spotify. I have no idea. But go do that there. Let the computers know you're enjoying what you're hearing and try to get the message out to more people. But again, we appreciate you being here. We'll catch you on the next episode. And just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.